Knowing the cost basis of your investments is a little bit like finding your location on the map at the mall that says, "You are here." Your cost basis helps to locate your spot in tax planning. If you don't know the cost basis of your investments, it may be hard to know exactly where to go from here. Whether you're managing a diverse portfolio or planning to pass assets to your heirs, grasping the concept of cost basis is crucial. We'll explore what it is, why it's important, how it's calculated, and debunk the top 5 misconceptions investors often have.
So Spencer, we've talked about cost basis before when we talked about our video on real estate and depreciation recapture and the calculation of cost basis there. But I think one thing that's often surprising is we have investors that have spent their entire lives putting money away in savings, whether it's in a mutual fund or stocks, that sometimes they still get confused about why their cost basis is what it is. And so today we want to dive into what cost basis is, how to think about it as an investor, but then as well, as you inherit resources, how do you think about cost basis? So what exactly is cost basis?
Well, let's give our nerd alert here because we're going to get into some minutia. We're going to talk a lot about different details, and there's some types of accounts that we really don't have to worry a whole lot about this. You know, a traditional IRA, a traditional 401k, typically we're not too concerned about cost basis there, although there is a little caveat that we'll get to later on. But cost basis basically locates our tax position if we think about our tax planning. And particularly with respect to a non-qualified account, we need to understand what did we put in, because the government's not going to tax us again on what we put in to that non-qualified account. Instead, they're going to look mainly how much did we gain or what's the interest that's coming in from that particular investment. So cost basis locates us there.
Okay, so when we think about cost basis, what are the very basic elements of it? Let's say just looking primarily at that non-qualified account. You buy a stock for $10,000, it gains to $15,000. What's our cost basis there?
Well, it's basically the tax value, and the starting point is the original purchase price typically. So we have that purchase price, but then we have to modify that in some different ways. If we have a publicly traded security, and let's say we get some dividends from that, and we pay tax on the dividends from that, then those dividends, let's say we started with $10,000, but we get, to make the math really easy here, we get $1,000 of dividends in that first year. Well, the dividends come in, we have to pay tax on those dividends, and now our cost basis in this very simple example goes from $10,000 up to $11,000 because we put in $10,000 originally, we had $1,000 of taxable dividends that were pushed out to us, and so now our cost basis is $11,000. It's actually a little bit the reverse of sometimes what happens on the property side of things, where we have a purchase price, but then we get to depreciate that property over time. So we get to include, some of those expenses, and basically the value of that real estate we recognize maybe goes down because it's not new anymore. And so the cost basis can actually drop over time on that individual piece of real estate if we have, property, if we have a home value on that in some circumstances. Whereas the reverse is true oftentimes if we're thinking about it, again, with publicly traded securities, because they will pay out interest income or dividends that will actually increase our cost basis over time.
Right. So why is this important to track the cost basis, to keep aware of it? It's not necessarily because the initial purchase, it's when we go to sell it. So walk us through why that's critical.
Well, the IRS wants you to pay taxes, and they want you to pay the right amount of taxes.
You sure about that? They want their money?
They want their money. And you don't want men in black showing up at your front door, knocking on the door and saying, hey, it's time to pay. So we have to make sure that you have your financial life in order, your investments in order. And so we basically want to make sure that we understand the amount of gain that you have when you sell that. Now, along the way, it's also important to keep good records, because if you have dividends that you're paid and you need to pay tax on those dividends, why, you need to make sure that you've accounted for those, or interest income, or these kinds of different pieces. So we want to make sure that if the initial investment, say in this very simplistic example, was $10,000, and along the way, maybe the account value grows to $30,000, well, we have to recognize, okay, was this a type of stock that pays no dividends and has no interest, that comes out, some kind of an investment there where it's really simple, and that the $10,000 went all the way up to $30,000, and there was no change in that cost basis of $10,000. So now we've got $20,000 of gain. Or the exact opposite would be that we had some kind of investment that was paying us interest, let's just say every year, and that increased every year such that the cost basis at the end of that time was $30,000. We sold it for $30,000. There's no capital gain on that. And that would be more typical of bonds and bond mutual funds or bond ETFs. There is usually some kind of capital gain or loss on those kinds of investments, but it tends to be more modest than what we see in the swings in the stock market.
Right. Okay, so we've kept our records. We have tracked what our cost basis is. What are some other important things to keep in mind about cost basis just in general?
Well, it's also important to recognize that there's going to be a big shift oftentimes when we inherit resources or we pass resources on to the next generation when we pass away in the cost basis. So there's a step up in cost basis. So if we had investments, let's just say we had in this investment $500,000 in a non-qualified account. Pass that on, and let's just say I pass away and I have a son that inherits those resources, and make it very, very simple. Have a non-spousal person inheriting those resources. Then there's a step up in that cost basis as of the date of my death. And there's a way that that's calculated. Typically, it's an average of the high and low of that particular day for that investment when I passed away. That cost basis then steps up. So I could have invested, and maybe I put $10,000 into, let's say, Apple stock. And Apple stock, let's say, rose to $500,000, and I passed away. Well, provided that everything is done to document this, then at the date of my passing, if the stock was worth $500,000, then my heir, my son in this circumstance, would not have to pay the capital gain on that $490,000 of increase there if, again, it was just a cost basis of $10,000 prior to me passing away. So it's important to recognize this with estate planning. And one of the things that we want to avoid as we think even about the tax planning side of things is to sell those resources maybe at the very end of my life and have all of that long-term capital gain that we've got to pay tax on. Right. So we want to see that cost basis, if the cost basis is much, much less than the account value or the security value there, then we want to be careful about moving those resources or selling them. But we wouldn't know that if we weren't tracking cost basis. Right. So that's why it's important that we maintain these records.
Yeah. And oftentimes the custodian that holds your resources will do this for you, but you want to make sure that you have those records as well, just in case there's a discrepancy. And you can go back to the custodian and you can say, no, I did purchase it at this, I've paid taxes on this. Mm-hmm. But oftentimes it will be handled by that custodian. But just make sure that you have records as well so that you can track it, make sure that everything aligns correctly.
And laws have changed such that over the last 10 years or so, custodians, if you make a purchase, say in the last 10 years, they're much more likely to have those records and document what your cost basis is if you've kept the resources with that particular custodian over that period of time. But if we go back, say, 30 or 40 years, oftentimes that cost basis will be unknown, and you'll have a process of having to go back and kind of reconstruct what the original purchase price was, and then dividends or other pieces that would influence a change of that.
Yeah. Okay, so the last thing we're going to talk about before we dive into how is that cost basis calculated on the back end when you go to pay your taxes is just it can affect your investment decisions. Mm-hmm. If one asset that has high capital gains or low basis, high value, then maybe not selling that one versus something that has a low cost basis. Mm-hmm. And there's a closer amount, or if there's losses in one and gains in another, there can be ways that you can handle this so that your tax bill isn't hit as bad. But in all these circumstances, just make sure you work with a tax professional, work with a CPA. So when we think about how cost basis is calculated on the back end for tax purposes, how are some of the common ways that it's calculated?
Well, we want to distinguish as well, there are different lots oftentimes of the securities that we purchase. Mm-hmm. So in the simple example where we purchase some Apple stock, but we have the dividends reinvested, mm-hmm. we might purchase, let's just say, 100 shares of Apple stock up front, but then as dividends come out, well, each one of those dividends, if it's a repurchase, we've got a different lot there that was purchased at a different time and has a different cost basis. So we've got to be careful as we look at how we address this. There are different ways that the government allows us to account for this. One would be what's known as FIFO, first in, first out. So that would be this idea that the first shares that you buy are going to be the first ones that you sell. So say again, you buy 100 shares of Apple stock, you have dividends reinvested, and down the road you have 120 shares of Apple stock. And you say, okay, I want to sell 20 shares. Well, there's different ways that you could sell those 20 shares, or different ways that you could account for those 20 shares in terms of your cost basis. But that first in, first out would be to take the 20 of the initial 100 shares that were purchased and to use that as your cost basis. So that would be a FIFO way of going about it. You could do specific identification. This would be where you would note that it's these particular shares. And oftentimes that would be the opposite direction, because let's just say, you bought Apple stock 15 years ago at a much lower price. Well, those dividends reinvested, maybe the last 6 to 12 months, they might have Apple stock that has a much higher share price per share. And you might want to sell those so that you don't have as much capital gain and tax due on that. So that would be specific identification. You could also go average cost or adjusted cost basis. With this over time, where you have some different types of ways that you can look at that calculation. The average cost is just what it seems. You have an average cost overall, and so you would use that and apply that across all of the sales. There it would be a running tally. Usually the custodian will help you out with that kind of sale there as well. Different ways that you can go, even in terms of how you calculate the gain from that cost basis, or the cost basis of the entire investment that might have a number of different lots to it.
Okay, so let's move over into some misconceptions. We're going to walk through 5 different misconceptions that folks may have. You've kind of already touched on this first one. Cost basis is always the purchase price. So we talked about how dividends and capital gains can affect the cost basis, but one that we haven't talked about is stock splits. How does that affect it?
Well, in different ways, because it depends on how the stock is split. Sometimes you have an even split and you end up getting 2 shares for every share that you had held, or 3 shares, or 7 shares, or some other. Or you could have, it could go the other direction, where actually you have 2 shares and now you get 1 new share. So what the government, as you might expect, they want you to keep track of this, and they just basically say, okay, if you had $10,000 of Apple stock and you had 100 shares of that, well, that equates to $100 per share. If they say, well, we're going to actually split the stock and now you have 200 shares, why, that cost basis per share is going to be half as much. So it's not going to be $100 anymore. It's going to be $50. So this is a fairly intuitive process for most folks in saying, okay, well, if I put $10,000 in originally and the cost basis has stayed there, I've been taking my dividends maybe just as cash dividends rather than reinvesting them or something like that, have that same original cost basis, then whether I have twice as many shares, 4 times as many shares, half as many shares, I'm just going to make a mathematical adjustment where my overall value, the overall cost basis, remains the same.
Right. Okay. Anything else with that first misconception that cost basis is always the purchase price?
The only other small piece here that we might have is sometimes in certain investments there can be a return of principal distribution or dividend. That's less common, but we do have to account for that in the other direction there as well. So we could have a return of principal distribution where the cost basis, theoretically, you could have $100 a share, and that could go to $95 a share if you had a $5 return of principal distribution there. So those are things that, again, your custodian is going to help you with. Typically, they're going to include that in the 1099 that's issued for publicly traded securities typically.
Okay, so let's move on to misconception number 2. Only stocks have a cost basis. So again, we talked about this with real estate in another video, that we're not going to dive into that calculation, but walk us through, what are the other things that have cost basis?
Well, really anything that you make an investment in has a cost basis. So that would, again, be the original, the purchase price, and then any adjustments that we need to make. So think about bonds. You buy a 10-year U.S. Treasury bond, and it's paying you, let's just say 4% to make the math easy. Well, the value of that bond, the price of that bond is going to go up and down some. So if you sell it and the price of the bond, instead of it being $10,000, now is $10,500, if the cost basis remains at $10,000, you're going to have a gain on that. Or it could go the opposite direction. So bonds would have that. Collectibles would have that. So, you buy these gold coins. There's a cost basis there. It's not going to move around. The gold coin is not going to produce more mini gold coins for you. So that's pretty easy in some ways, but you have that cost basis. Mutual funds, you have a cost basis. So you put a certain amount into mutual funds, and it's a collection oftentimes of stocks and bonds or just one of those assets. But those are going to have their own particular cost basis. They may issue dividends and distribute those to you, and then you've got some movement in that cost basis that you've also got to account for. Probably our favorite one that we encourage typically clients to steer very far from is cryptocurrency. It has its own cost basis, and the delight with cryptocurrency, as you know, is that every transaction that you make has to be accounted for in terms of the tax implications. So, you purchase some cryptocurrency, and then you have the joy every time thereafter of saying, okay, did I sell it for more or less? And trying to keep track of that cost basis is just a royal pain for most people. So anything that we're investing in, whether that is real estate, mutual funds, individual stocks, bonds, collectibles, cryptocurrency, it has a cost basis there that we have to keep track of.
Right. And typically, capital gains are going to be taxed at your long-term capital gains are going to be taxed at either 0%, 15, or 20%. And you've got also net investment income tax, et cetera, et cetera. But with collectibles, they're going to be taxed at 28%.
Oh.
And the depreciation recapture for that real estate is up to 25%. And so, again, what we'll often say with this is you really need to work with a tax professional. So make sure that you're keeping good records and working with your tax professional when it comes to selling these items. So let's talk about misconception number 3. Cost basis does not affect inherited assets. Why is that a misconception?
Well, it's a misconception. There's this thought process that when you inherit resources, there's a step up in cost basis, and so you're not going to have to worry about it. Generally speaking, there's going to be less tax liability for you if those assets had a very low cost basis, and now your loved one passes away, they pass those resources on to you. Now you have a much higher cost basis oftentimes, but there's still a cost basis. Still has to be accounted for there. So you might wipe out, again, the bulk of the tax, but the government is still going to expect that as you sell investments that you maintain records and show, okay, well, this is where the cost basis stepped up to, and this was the capital gain or capital loss that I had thereafter. All those different pieces are still in place. It's just that you may not have as much of a tax bill.
Right. All right, so Spencer, we've talked about 3 of these misconceptions so far. Let's go ahead and move on to the 4th. It's okay to estimate cost basis. I think I bought it for this. That's probably what it was. The government is okay with that, right?
No. Estimation does not work for the IRS.
Okay.
So getting close only counts, as they say, in horseshoes and hand grenades. So we need to make sure that we are looking at this with precision as much as we can. Now, there are circumstances openly where we've had clients that have inherited resources. They're not even sure when their loved one passed away. It may have been 60, 70 years ago, and they don't have appropriate records. And in those kinds of circumstances, we say, work with the CPA. They're going to lead you through this. And if they need to write a letter to help you explain things to the IRS, do so. And there may be, they may give you counsel that the best you can do is estimation and such. But work with a tax professional on that before you go in that direction.
Okay. So the last misconception for today. 401ks and IRAs never have cost basis, right?
Yeah. So that's, again, a misconception. There is a level of nuance here. So oftentimes we'll work with clients that their 401k, their traditional IRA, it's all pre-tax. Everything is simple. Or we work with them and they have all of those resources are pre-tax, and then maybe they have a Roth IRA, also very simple, has its own set of tax consequences, circumstances, and rules. But sometimes we find that there actually is basis within a 401k, within a traditional IRA. And that's typically when we have contributions made above and beyond the deductible amounts there. So let's just say for the traditional IRA, we have a client that has a high level of income. Maybe they have access to an employer-sponsored plan like a 401k, and yet they still make a contribution to a traditional IRA. Well, that's going to be non-deductible, so they're not going to get any tax credit for that going in. And what they need to do from that point going forward is to make sure that they are accounting for that contribution. It is the basis of that account now. So that is a tax benefit, but it can also be kind of a thorn in your side. So we'll get into this in just a moment, but just understand that if you're making an after-tax contribution to a traditional IRA or to a traditional 401k, let's just say you're setting up a 401k and you make as much as you can in terms of contributions that are within the plan allowance for pre-tax or the Roth side of things. Anything above and beyond then is going to be treated as an after-tax contribution. So not all plans allow this, so you need to look at your summary plan description, talk with your administrator there to make sure that you understand the scope of this. But let's just say in 2024, you make a $23,000 contribution. That's a pre-tax contribution on the employee side. Let's just say that you're beyond age 50, and so you can make that catch-up contribution there as well, another $7,000. So you're making $30,000 as a contribution to your 401k pre-tax, and you're getting your match from the employer, again, pre-tax resources. Some plans would allow you to give or to contribute a significant amount above and beyond that. So let's say in this example, you contributed another $20,000 to the 401k. That is going to be coded or categorized as an after-tax contribution, typically. And that is interesting in terms of the tax implications because you're not getting a tax write-off, you're not getting a deduction on those contributions. So it's kind of treated like a Roth, but the gains from that after-tax investment there, the contributions that are made, they are not taxed in the same way that a Roth 401k contributions would be taxed. Typically a Roth contribution, the gains would not be taxed provided that they are taken out later on via qualified distributions. In this case, though, these after-tax contributions, the gain on those gets slotted back over to the pre-tax side of things. So what we want to do is, as a client maybe approaches retirement and they have options there, typically those after-tax resources, they get rolled into a Roth IRA because then once they get into a Roth IRA, then those after-tax contributions that, again, any gains that they would have had within that 401k would have been taxed as ordinary income typically upon distribution. Once they get into the Roth IRA side of things, any of the gains from that point are going to be treated just like other Roth IRA gains. So there's a lot to kind of unpack there, but just know if you have a traditional IRA and you make non-deductible contributions or a 401k make non-deductible contributions, you do have cost basis that needs to be accounted for. It can be helpful, but you need to make sure that ultimately that you try to get that over to the Roth side of things. The hardest thing that can be here is if you have a traditional IRA with basis and you're taking distributions from it, it's a royal pain. Mm-hmm. Let's say you have $1 million IRA, you have $20,000 of basis. What the IRS expects you to do is that for every level of distribution, that it's coming out pro rata. Mm-hmm. So let's say you take out a distribution of $15,000 a couple of times in a given year, they're going to expect that you do a calculation and figure out what the pro rata amount of basis that comes out in each one of those transactions. It can be a royal pain. Now, CPA can help you with that, but most of the time what we're looking for if we have a client in that circumstance is a way to clean things up and get the pre-tax resources segmented in one spot and the after-tax over with the Roth resources in another spot so that the accounting is fairly simple and that the tax calculations likewise are fairly simple.
Right. So Spencer, what would be a typical way we would clean that up?
Well, if possible, what we would do is take the traditional IRA, the resources where we have a cost basis, and if possible, if a person's still employed, we might roll everything into the 401k. So what would happen is we would move all of the pre-tax resources, I should say, into the 401k, into the pre-tax side of the 401k. What's left over is the cost basis, usually a much smaller amount in that traditional IRA, And then ideally, we do an immediate Roth conversion or a Roth conversion soon thereafter where there's very little gain there, taxable amount. And then those resources, then they end up in that Roth IRA side of things, and we don't have to account for this pro rata distribution going forward.
Right. Okay. So we'll just take a couple seconds here and just walk through some practical tips. We've kind of already covered most of these, but one, keep really detailed records. Again, it's really important if you ever get in an audit situation, make sure you have those records. 2, use financial software. The reality is digital storage is really cheap. And so with number 1, just keep an online digital storage of all of these files. And 2, you can use a financial software to do that, whether it's Excel or working with your custodian or any of these other situations. Work with a financial advisor to make sure that your cost basis is tracked. 3, just regularly review those statements. Make sure that your custodian is tracking the basis appropriately. Finally, work with a tax professional. Spencer and I are not CPAs. We are not enrolled agents. We cannot file taxes. We cannot calculate your basis and put a stamp on it and say the IRS will approve this. We cannot do that. So work with a tax professional that's going to be on your side, that's going to be advocating for you. And with that, is there anything else you want to cover today, Spencer?
No, I think that's it.
All right. Well, if you enjoyed this video, feel free to share it, leave a comment down below, and we'll see you next time. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.